Trusts are a flow-through tax structure, which means that distributed income is taxed at the beneficiary's marginal tax rate, potentially up to 47%, including the Medicare levy. If trusts do not pay distributions, the trust will pay tax at the highest marginal rate of 45%. Centuria LifeGoals is an investment product traditionally known as an investment bond. It offers many of the benefits of a company with a maximum 30% tax rate less allowable deductions. It's similar to a managed fund. It has a range of professionally managed investments across multiple asset classes. It's similar to superannuation in that the fund pays tax, not the owner, and it's got the certainty and security associated with a life insurance policy in that there's a life insured and the beneficiary can be nominated. Trusts must pass their distributions to beneficiaries or be taxed at the highest rate of 45%. However, investment bonds do not pay distributions and the fund pays tax internally at a maximum rate of 30%. So consider the following scenario with a discretionary family trust. Adult beneficiaries on 30% or more, or the top marginal rate of 47%, and minors as beneficiaries whose effective tax rate could be as high as 66%. Trust earnings must be distributed to the beneficiaries who are paying tax at a very high rate. If the trust was to invest in Centuria LifeGoals, the earnings do not need to be distributed. Instead, they would be taxed within at a maximum 30%, and this would allow a greater amount to be reinvested, which leads to greater compounded returns. If the bond is held for more than 10 years, then the earnings are available to be distributed to the beneficiaries with no further tax to pay, irrespective of their marginal tax rate, and this is known as the 10-year rule. Many wills can be successfully challenged in the courts. The most common form of challenge is under the Family Provisions Act, where courts can overturn the wishes of the will maker, and this can affect testamentary trusts too. Investments in Centuria LifeGoals have a nominated life insured and a nominated beneficiary. And so in the event of the death of the life insured, the funds pass to the beneficiaries free of tax and the proceeds do not form part of the estate and therefore cannot be contested. So using Centuria LifeGoals as part of your estate planning strategy will ensure that the funds go to those that the will maker intended and overcomes the costly and time-consuming process associated with probate. Well, yes, if a trust is distributing to a corporate beneficiary, sometimes referred to as a bucket company, an investment bond strategy may help. This is because distributions to a corporate beneficiary are only a temporarily delaying of the payment of tax, as income source dividends and realised growth, when they're paid to an underlying shareholder, must be paid at their marginal rate of tax, which may be higher than 30%. Maintaining a company or winding it up also have costs, and it may be more cost effective and certainly tax efficient to incorporate use of an investment bond. Absolutely. Although we recommend people always seek professional advice, but a bond can play an important complementary role. Being a regulated life office structure, the assets held in a benefit fund enjoy creditor and bankruptcy protection, whilst also giving simple estate planning access to capital. And remember the power of assignment. An investment bond can be assigned or transferred at any time and to anyone with no capital gains tax payable.